All right, let's move on to evaluating company strategies. All right, once you settle on growth or value, you can then use the industry life cycle and competitive analysis to identify industries that will likely include growth or defensive companies. So you can use life cycle and you can use competitive analysis to find these growth and these value industries. Once you find growth or defensive industries that you're looking for, the next step is to evaluate company strategies in order to determine prospects for sales and earnings for the companies in those industries. Okay? Look for industries, well, let's not get ahead of ourselves. As you assess company strategies and attributes, do not forget to integrate company-specific information into the expected macroeconomic and industry environment. Okay? Search for companies that will have the most leverage, benefit the most from the macroeconomic conditions that you expect. This is classic top-down. What do you expect to happen with the macroeconomy? Is it time to get defensive or to get aggressive? And what kind of industries fit those profiles? Once you decide whether it's time to get defensive or aggressive, once you decide which industries to overweight or underweight, then you start looking for companies in those industries. Okay? For example, if the economy and certain industries are expected to be robust, the most attractive investments, and may not be the industry leaders, the leading companies in the industries, but maybe the marginal firms that have very high operating or financial leverage that will benefit the most from the good environment. If you are expecting a really good environment for an industry, this may be a good time to look for riskier companies, companies that have high operating leverage or high financial leverage. These are the companies that tend to do the best in a robust economy. Okay? Alternatively, if the economy is shifting from higher growth to lower growth, investors might be better served to move out of these riskier stocks and bonds and into safer ones. Okay? This may be the time, and here we are in the late stages of an economic cycle and economic expansion currently, 2018, and the economy has been growing for the most part for the last 10 years, and it may be time to de-risk, if you will, and to move from the marginal companies to the more mainstream, more strong companies. If we can, I think there's still time to remain in growthier type stocks, but if we see the economy start to decelerate, we see economic data starting to slow down, then not only do we move from the marginal stocks to the good, strong stocks, but we move from the growth stocks into the defensive stocks. All right? You may also find attractive long-term investment opportunities within industries that are experiencing difficult times. Don't rule out those industries that are not going through a really good time. Often investors become overly pessimistic during these times, and this results in stock prices becoming undervalued. So once again, just because industry conditions look bad doesn't mean you should completely rule them out. If you can find some good companies that are extremely undervalued, if it fits into, if you have a waiting period, if you can hold on long enough for the economy to turn around and for the industry to turn around, when stocks are out of favor, that's a good time to buy. All right? And this is what value investors are looking for. They're looking for good companies that have stocks that have gone out of favor, that are selling very cheaply, and it looks like there's some opportunities. All right, what are some structural influences that we look for that affect company strategies and the economy? So these are themes that, that strategists look for, okay? Social trends, all right? Things like demographics, consumer tastes or lifestyles, okay? These are long-term trends that affect industries and companies, okay? Technology, okay? Innovation, customer service, lower costs. These are long-term trends that people look for. The political or the regulatory environment, okay? Deregulation, okay? Breakthroughs like the fall of communism, the rise of free trade, okay? What are we getting now? We're getting less free trade and more fair trade. Who's going to be hurt and who's going to be helped by these things? Okay, these are long-term strategies or long-term factors. All right, looking at company strategies basically boil down to two different approaches. One is the low-cost strategy. Okay, with the low-cost strategy, you strive to be the low-cost producer or provider, and hence you are the price leader. If you are the low-cost supplier, then you can set the price because you can lower the price. Cost advantages may include economies of scale. Okay, there could be a barrier to entry into an industry because of the huge investment that has to be made. An industry like transportation, like FedEx or UPS, very difficult for people to compete in that industry because of the amount of capital that you need. Okay? Proprietary technology that you might have that would keep people out of your business. Exclusive distribution channels, that used to be the case, not so much anymore with the internet, meaning you control the retailers that carry the products. Or preferential access to raw materials. Are there certain raw materials that you now own the rights to, and you can shut out your competition? Okay? The low-cost producer or provider should set its prices near the industry average. Don't be too aggressive if you're the low-cost provider, because if you're too aggressive, then you're going to leave money on the table. Your margins will be too thin. So don't get too aggressive. Just because you can set prices low doesn't mean you should set prices too low. All right, then there's the differentiation strategy. So we have the low-cost strategy, and now we have the differentiation strategy. Firms seek to identify themselves as being unique in their industries. Okay? This is done using products, distribution, or promotion. I would say compare Hewlett-Packard or Dell with Apple. Dell is a low-cost provider. They don't do anything that's very sexy. Apple is not a low-cost provider. They don't want to be a low-cost provider. They want to be a differentiation provider. They want to provide products that have real flair, and you know that they do. Okay? So, while money can be made in the stocks of companies that pursue either of these strategies, industries characterized by competition based on differentiation tend to be faster growing. Okay? If you focus on innovation, not on prices, and they tend to have higher or rising profit margins. Apple's profit margins are much, much higher than Microsoft's profit margins and any of the other hardware companies. Okay? The stocks of companies like this generally do well for extended periods of time. All right, so what we're looking for is differentiation. Amazon versus Walmart. Walmart is now moving toward Amazon. Walmart was the disruptor back in the 80s. It was Walmart versus Sears and Kmart. And Walmart was the innovator. And then Amazon became the innovator. And this is what happens, the disruptors. All right, alternatively, when competition is based on price, that usually means the industry is mature. Okay? So we're late in the game, growth slows down, and stronger companies are taking market share away from weaker companies. And this is due to economies of scale. Okay? Often profit margins are thin. When competition is based on price, profit margins become thin, and there are usually fewer investment opportunities within such an industry. These industries tend to consolidate, and you have fewer opportunities to invest in these industries. Okay? And so when these industries are consolidated and they become very economically sensitive, there are still opportunities to find investments, but they are trading investments. These are not stocks that you buy and hold for 3, 4, 5, 6, 10 years. These are stocks that you might buy and hold for a year or 2 at the most. And when the economic environment changes, that's when you have to get out. Okay? All right, that's it for this clip. We have one more clip, and we'll finish chapter 13, a very short chapter compared to chapter 12. Shalom.